Recording in progress.
A very good afternoon to you all, friends. I am C.S. Sanjeev Singhal, Central Council member and the chairman of the Auditing and Assurance Standard Board. On behalf of the AASB, on my behalf and on behalf of my chairman, C.A. Vishal Bhai Doshi, we welcome you all on this very important webinar on what are the key audit considerations while doing an audit of financial instruments. Friends, we all understand that financial instruments have a complex accounting, and it is very important because they are a substantial amount as compared to balance sheet size in case of many companies. In India, the financial instrument standards were never made mandatory during the accounting standard regime, but under Ind AS, these are integral part of the overall scheme of Ind AS. And we have Ind AS 32, Ind AS 107, and Ind AS 109. So 3 important standards are there. Earlier there was Ind AS 39 also. It's very important that that you have an overview of the requirements of the financial instruments so that you can keep in mind the same while doing the audit. And this is our 86th program for this council year. So in 3 months, it's the 86th program that we are doing on various topics as far as the AASB is concerned. And we are also presently running an expert helpline in which you can ask your audit-related questions. This is operational from 16th April and will be there up to 30th of April. Will be there up to 30th of September. So please make best use of it. And I have the pleasure of sharing with you that today we have an expert speaker, Ayush Aggarwal, who is a chartered accountant from ICAR and Bachelor of Commerce from the Calcutta University. He's a partner with Ernst & Young with the Financial Accounting Advisory Services. And he has more than 16 years of experience in accounting and financial reporting, providing multi-GAAP accounting advisory services. And he has extensive experience in transactions like carve-outs and GAAP conversion and engagement. And he is well versed with the Indian GAAP, IFRS, and US GAAP. And he has been a very eminent faculty with the Institute of Chartered Accountant of India. And it's always a pleasure to listen to Ayush. So thank you, Ayush, for taking out time. I know this is a pretty busy time. So thanks for taking out time during these busy time. And as usual, I'm sure that participants will be immensely benefited with your deliberations. Thank you, and over to you, Ayush.
Thanks a lot, Sanjeev sir, for the kind introduction. And as always, it's an honor to speak on any topic, in front of such a wide audience. And kind of thinking that close to 700 participants already in the meeting, would have been a wholesome experience if this training session or this session would have been in person. So look forward to it next time as well. But definitely, I'm more than happy to give my 2 pounds on this topic on audit considerations related to financial instruments. So, to run the session or to talk on the topic, I definitely have a PPT. But before I share the PPT, let's really understand very broadly financial instruments and what can we expect out of the session. So we are, we will try and understand some of the audit considerations on financial instruments. Now, specifically, this topic deserves special attention. And of course, this topic should not be commingled with the audit considerations related to any other balance sheet caption or P&L caption, because financial instruments is a specific complex subject in itself. So the accounting considerations of financial instruments are also driven by a set of complex standards. Hence, the audit considerations also surrounding the same is going to be very specific and, of course, a bit complex. To understand the audit consideration, it's very important that we understand the basics of the standard. And I will definitely touch upon the basics of the standard. But before that, I mean, just sharing that under erstwhile Indian GAAP, because AS 30, 31, it never became mandatory on financial instruments. So under Indian GAAP, the guidance on financial instruments was a bit scattered. I mean, there was a primary standard in the form of AS 11, which dealt with exchange rate differences on financial assets and liabilities. Then there were some guidance note on securitization and stuff, which very, very partly dealt with some very specific subject. Then there was a guidance note on derivative accounting as well. So kind of that there was some scattered guidance. But under Ind AS, if you see, under Ind AS, the primaries, there are 4 standards, first of all. The primary standard is Ind AS 109. Ind AS 109 deals with primary accounting of financial instruments, which is recognition and measurement. Then there is another standard, which is Ind AS 32. Ind AS 32 deals with classification of financial instruments, which is another very important area. Then there is Ind AS 107. And Ind AS 107 deals with disclosures of financial instruments. And I mean, needless to say, if any of the participant has gone through an Ind AS financial statement, I mean, quite a significant portion of the notes to accounts are attributed to financial instruments. I mean, be it the disclosure related to credit risk or market related risk, or disclosure related to fair value, and a lot of disclosures. All these disclosure requirements are coming from Ind AS 107. Then there is another standard, although not directly related to financial instruments, or not only or solely related to financial instruments, but this standard is Ind AS 113, fair value measurement. Lot of disclosure requirement and a lot of direct correlation of financial instruments can be found in this standard. Why I say so is because as we see the accounting of financial instrument, financial instruments accounting is fair value accounting. Any financial instrument, if you see, I mean, you will see the general requirement of recognizing the same at fair value. And determination of fair value, we have to really go into Ind AS 113 to check the guidance on fair valuation. That's where Ind AS 113 also becomes very important as part of the overall financial instrument accounting and auditing. Now, these are the 4 standards which guides financial instrument accounting. Let me tell you, I mean, there is a general, or at least now a large part of that understanding has gone among the participants or the users of the financial statement. At least there was a general myth that financial instrument accounting is largely applicable to banks and insurance companies, or to say to financial service companies. I mean, it's only a myth. If you are an accounting expert or interested in financial statement, you will more than agree to the statement that financial instrument accounting is applicable to all the financial statement. It can be company in any sector, it can be company in any business. Be rest assured that financial instruments will be one of the highly impacted standard in the balance sheet. And we will see why, I mean, as we come into the standard. With this background, let me just share my presentation. I hope my presentation is visible. Anilji, just a word of confirmation from you will be helpful.
Not yet, sir. Abhi nahi.
Shall I share again?
Yes, sir. Kindly.
Hold on, just give me 2 minutes.
Yes, sir. Yes, sir.
Now, is it visible now?
It is visible, sir.
Thank
Go
you.
to the
Thanks a lot.
slide number 2, sir, please.
Yeah.
Yes, sir. Visible.
Yeah. Okay. Thank you. So with this, I mean, let's just have a look. Let's go through some of the auditing consideration on financial instruments. Yeah. Now, what is a financial instrument? A financial instrument is we will see what is a financial instrument is basically a financial asset or a financial liability. A financial instrument is a financial asset of one entity, and the same instrument will be a financial liability for another entity. I mean, if we understand that this by way of an example, a debtor of one company will always be a creditor of another company, and you can put this in parallels for any other financial instrument. I mean, an investment for one company will be an equity for another company. So a financial instrument is any contract which gives rise to a financial asset for one company and a financial liability or an equity of another company. What's important here is to note that a financial instrument is always represented by a contract. It's a contractual right to receive future cash flows, or it's a contractual right to pay future cash flows. If there is no contract, there is no financial instrument. It's as simple as that. So it's always represented by a contract. Now, let's look at the definition of a financial asset and that of a financial liability. Now, a financial asset is either cash. Now, this is the definition straight out of Ind AS 109, and let's just understand what this definition really tries to cover within its ambit. A financial asset is either cash, very straightforward, or a financial asset is equity of another entity. I mean, if there is an investment into the equity instrument of another entity, that is straight away a financial asset. Then a financial asset is a contractual right to receive cash or another financial asset from the counterparty. Very important, contractual right to receive cash. That is a financial asset. So just taking 2-3 examples. I mean, a debtor. Now, a debtor is always a contractual right to receive cash, or a loan given to another company. It's again a contractual right to receive cash. So it's a financial asset. Taking another example, an advance given to a supplier for purchase of machinery or for purchase of raw material or inventory. That is not necessarily a contractual right to receive cash. I mean, it's a contractual right to receive products, and that's where it's not a financial asset. So very important to see that where there is a contractual right to receive cash or another financial asset, that contract is a financial asset. If there is no contractual right to receive cash, there is no financial asset in existence. Another aspect which the definition covers is exchanging financial asset or financial liability with another entity under conditions that are potentially favorable to the entity. Now, what is this? If there is a contract to exchange financial asset with a counterparty under conditions which are potentially favorable to the entity, then that contract is a financial asset. So right opposite of it, if there is a contractual right to exchange financial asset under conditions which are potentially unfavorable to the entity, then it will become a financial liability. Let me explain this by taking a very simple example. Let's say that a company took a call option to buy shares of a particular company. But the call option was taken at a strike price of, let's say, 90 rupees. Now, what will happen? I mean, if as the holder of the call option, when the price of the share will exceed 90 rupees, let's say the share price in the market actually becomes 92, 93 or 95, that is the point of time when the call option will be in the money for the holder, which means that is the point of time when the conditions will be potentially favorable to the holder or potentially favorable to the entity. Now that is a financial asset, because that is the right to exchange financial asset under potentially favorable condition. So for the entity, it will become a financial asset. Now, same contract, if you look at it from the point of view of the writer of the option, I mean, if the entity has got the call option to buy, someone else has got the same option to sell, which is the writer of the option. Now, from the point of view of the writer of the option, it has turned negative. The conditions have become unfavorable because the option has now got a market value of 95 or 96, and the writer will have to honor the contract at a value of 90 only. So from his perspective, it has become a potentially unfavorable condition. So the person or the entity for whom the conditions are favorable, it's a financial asset for him. And for the entity for whom the conditions have become unfavorable, it's a financial liability for him. That is another aspect of the definition. So financial asset is anything which is a cash or equity of another entity or a contractual right to receive cash. And then if there is any contract to exchange a financial asset or a financial liability, then financial asset is where the conditions are favorable and financial liability is where the conditions are unfavorable. Right opposite, if I see, right opposite the definition of a financial asset is the definition of financial liability. Financial liability is a contract or a contractual obligation to deliver cash or exchange any financial asset or financial liability under potentially unfavorable conditions. Another aspect of the definition is if the company has entered into any contract which will be settled into entity's own equity. Now, what is this? Let's spend some time on this. Any contract will be settled in entity's own equity and is a non-derivative for which the entity is obliged to deliver a variable number of its own equity. Now, let's say that the company has issued a compulsorily convertible debenture. I'll take two very simple examples here to make you understand. If the company has issued a compulsorily convertible debenture, let's say the debenture was, let's say 1,000 units of debentures were issued, and the condition was that the debenture will be mandatorily converted in the ratio of 1:1 after a period of 3 years. Now just look at this definition, look at this condition in substance. 1:1 conversion means that 1,000 unit of debentures will be converted into 1,000 equity shares at the end of year 3. If you really look at the risk and reward of this instrument, the risk and reward of this instrument is very much akin to equity and not liability. Because if the price of the equity goes up, the counterparty stands to gain. If the price goes down, the counterparty stands to lose, and so on and so forth. So the risk and reward is very much akin to equity. Whereas, just taking another example, let's say a compulsorily convertible debenture was issued, again 1,000 units, 1,000 units for a value of 10 lakh rupees. And the condition is that the debentures will be converted into equity at the end of 3 years based on the fair value of equity equivalent to 10 lakh rupees. Now, in this case, what will happen is that at the end of 3 years, the fair value of equity will be determined and 10 lakh rupees will be divided by that fair value and equivalent number of equity shares will be issued. Now here, the counterparty is more interested to secure their 10 lakh rupees. They want their 10 lakh rupees back in the second instance. So in the second instance, the risk and reward is more akin to debt as far as the company is concerned, as far as the counterparty is concerned. And that's where you see in the second instance, the number of shares which will be issued is variable. It's not fixed. Where the number of shares are fixed, which will be issued, the risk and reward becomes more akin to equity. But where the number of shares are variable, there the risk and rewards are more akin to debt, and that becomes a financial liability. So all those contracts which will be settled in entity's own equity, whether it's a derivative contract or a non-derivative contract, if it will be settled in variable number of shares, it will become a financial liability. The same holds true in the case of a financial asset also. Where the settlement will happen in fixed number of shares, it will become an equity, it will not become a liability. That is another aspect of the definition of financial liability. It will only be applicable where there is a contract which will be settled in entity's own equity. But keeping the definition simple, largely financial liability is a contractual obligation to deliver cash. Now, if you look at a balance sheet, I mean, we are trying to study, or we are trying to cover here the risks to which the entity may be exposed through use of complex financial instrument. Now, financial instrument, both a financial asset and a financial liability, it will give rise to a lot of risks. And we will look at those risks. We will try and agree also that these risks are very much present as part of financial instruments. But just the definition which we studied of a financial asset, or the definition which we studied of that of a financial liability, if you see what all assets in your balance sheet can become a financial asset. What all assets can become financial assets? I mean, very simply, a debtor in your balance sheet will become a financial asset because there is a contractual right to receive cash. An investment in your balance sheet, I mean, no matter what, be it investment in a mutual fund, or an investment in a equity security, or an investment in a government bond, any kind of investment will always become a financial asset, because again, it's all contractual right to receive cash or another financial asset. Then any loan given to a counterparty is always a financial asset. Then any derivative instrument is always a financial asset or a financial liability. So all these assets, any security deposit, I mean, for any purpose, any security deposit given to a counterparty is always a financial asset. All these assets where there is a contractual right to receive cash is financial asset. Similarly, liability, if you see a bank borrowing is a financial liability because it's a contractual obligation to deliver cash. Any loan obtained from a related party or any other party, or any working capital obtained from a related party or an unrelated party, all those are contractual obligation to deliver cash. So those are financial liability. Now, it's very important to understand that these financial assets or financial liability will carry a number of risks which are inherent to the financial instrument, to the respective financial instrument, because of the nature of the financial instrument. It's very important to identify those risks, and it's very important to understand that these risks identification is also mandatory by the standard Ind AS 107, and those risks are required to be disclosed as part of the financial statement notes to accounts. And the auditor's responsibility is, of course, to vet the underlying financial instrument, and in turn to vet and audit the underlying risk as to whether the same risk is present or not. So what are these different risks? Of course, market risk. Market risk means that because of external forces or because of market-related forces, there is a potential risk of an upside or a downside to the cash flows of the underlying instrument. Those are all market risks. Very simple example. I mean, an example of market risk. Market risk will entail currency risk, interest rate risk, price risk, volatility risk, all these risks. Taking 2-3 examples of market risk. Let's say if there is a foreign currency debtor, a foreign currency debtor will always entail a currency risk. The dollar rate or the foreign currency rate can go up and down, and the respective future cash flows will have an upside or a downside risk. That's a currency risk, which is attributed to external forces, market-related risk. If any investment in a mutual fund or a bond, it will always entail an interest rate risk. The interest rate may go up and down, and thereby there will be a future upside or a downside to the future cash flow. Similarly, any investment in an equity security will always entail a price risk. The price may go up and down, and thereby an upside or a downside in the future related to the future cash flow. All these risks are market risk. Now, all the financial instruments which entail such market risks should be identified. The related risk has to be disclosed in the financial. These are market risks. Then, of course, the financial instruments and virtually all financial instrument, be it particularly financial asset, it will entail credit risk for sure. So credit risk means that the risk that the counterparty may not oblige their obligation, the risk that counterparty may not pay on time or may not pay at all related to the financial asset, that is a credit risk. So all those financial instruments which entail credit risks should be identified and should be disclosed. Of course, in order to counter the credit risk, I mean, there are provisions related to expected credit loss method, etc., of impairment as well to cover, to reduce the financial statement volatility surrounding it. But credit risks are inherent in financial instruments. Then liquidity risks. Liquidity risks means that the company can increase their liquidity, and in turn there is a risk that there can be a potential non-payment on part of the entity, a potential liquidity risk in the future. I mean, the entity can increase their own exposure to borrowings, and hence there is a underlying liquidity risk. So in the case of a liquidity risk, the maturity profile of the related assets and the liabilities are required to be disclosed, which the auditor is required to vet. Apart from that, these specific risks, I mean, financial instruments will always carry a set of operational risks. These operational risks basically, they arise because of the complex nature of financial instrument. Yeah, these operational risks will arise, or these operational risks are always there in practice because of the complex nature of financial instrument. If you are doing financial instrument accounting, you can be rest assured that operational risks will be there because the subject of financial instrument is complex. Hence, the companies always deal with this challenge of in-depth understanding of the transaction and financial instrument accounting. That risk will always be inherent in any company you deal with. Then there is always a risk of inappropriate documentation. I mean, financial instrument, if you are dealing with, let's say, a derivative, or you are dealing with, let's say, a hedge accounting or something, there has to be appropriate documentation. And there will always be a risk that whether all the companies understand this detailed set of complicated or complex documentation requirement. So a risk of inappropriate documentation is always there. Then valuation risk is always there. I mean, any financial instrument is required to be recognized at fair value. And hence, I mean, how accurate is the fair value, how the entity is determining the fair value, whether the entity is reviewing the fair value or not. Those valuation risks are always inherent in financial instrument. And whether there is sufficient monitoring of financial instruments in the company or not, that risk is there. Understanding of these risks as an auditor is very, very important. I mean, and of course, given the veracity and given the depth of the risk, the same should be addressed. If if let's say sufficient personals within the company are not there who understand the complex accounting of financial instrument, maybe the auditor will devote more time to see whether there is any accounting error, I mean, while recognizing or measuring or classifying any financial instrument. So depending on the risks, to which risk the entity is more exposed, thereby the auditor will understand that risk and will devote more time in addressing that risk. Now, before I cover this, key audit considerations, let's understand the very basic accounting of financial instrument. I mean, so far we discussed the definition of a financial instrument, the definition of a financial asset, definition of a financial liability. The financial asset and a financial liability are all exposed to some basic risks, which are market risk, operational risk, liquidity risks, and stuff. Now, coming to some specific audit consideration. Now, audit consideration definitely for us to understand and comprehend the audit consideration well, we should understand the basic recognition accounting of a financial asset and a financial liability, and thereby we would be able to comprehend the audit considerations as well. Now, what is the basic accounting? A financial asset. Now, I will break a financial asset into three categories. A financial asset can either be an investment in an equity security, or it can be a derivative, or third is a residual category, any other financial asset. Now, an investment in an equity security. First of all, if that investment in an equity security is held for the purpose of trading, it's compulsorily fair value through P&L. Okay. Why I am telling you this is just look at the amount of judgment involved on part of the company. And the more the judgment on part of the company, the more complex it is for the auditor to audit. Now, if an equity security is held for trading, it is recognized at fair value through P&L. So if a company is taking a stand, that an equity security is held for trading, an auditor is really required to check the documentation that how the company has arrived at that decision that a particular equity security is held for trading. Now, second aspect is if an equity security is not held for trading, then there is an accounting policy choice. Either the company can designate the equity security at fair value through OCI, or if the entity does not use the designation, then it will be fair value through P&L. If the entity uses the designation of fair value through OCI, then all the gains and losses related to the equity securities, right from the start till the last day, will all go to other comprehensive income. And as I said, if the entity does not use the designation of fair value through OCI, then it is fair value through P&L. That is an investment in an equity security. Then the second category of financial asset I covered is derivative. All the derivatives, unless hedge accounting is followed, all derivatives are compulsorily fair value through P&L. Then the third category is residual category, where any other financial asset which does not fit in the first two categories will come and fit in the third category. Now, what in the third category, what we need to do is that whatever financial asset falls in the third category, I mean, be it an investment in a mutual fund, or a debtor, or a security deposit, anything, the company needs to check the contractual cash flows out of that asset. In terms of the standard, it is known as business model test. That what are the contractual cash flows out of that asset, and whether the business model of the company is to hold the asset in order to collect the contractual cash flows. Keeping it simple, if the business model of the company is to hold the asset in order to collect the contractual cash flows, then that asset is recognized at amortized cost. If the business model of the company is dual, that either hold the financial asset to collect the contractual cash flows or sell the financial asset, is dual, then that financial asset is recognized at fair value through other comprehensive income. And then any other financial asset in the third category is recognized through fair value through P&L. That is the entire recognition accounting of a financial asset. And similarly, the recognition of a financial liability, all financial liability, I mean, unless the entity has taken a designation choice of fair value through P&L, the financial liabilities are recognized at amortized cost. This understanding of financial asset recognition methodology and financial liability recognition methodology is very important, because you see a lot of judgment has been given in the hands of the companies, and thereby which will drive the recognition. And thereby the auditor also needs to just consider those judgments in order to audit the same. So any financial asset, if you see, I mean, it's imperative for the auditor to understand as to why the company is entering into such instruments. Very imperative or very important to understand what is the business model of the company. As I said, that whether the business model of the company is to hold the asset in order to collect the contractual cash flows, or whether the intention is dual, or the company has not set in place any business model. What is the business model of the company with respect to that financial asset? That is a very important consideration, audit consideration. Then the third very important audit consideration is understanding the underlying terms and conditions of the financial instrument, and very importantly, understanding the exact terms. I mean, what is the period of maturity? What are the exact terms, conditions, and characteristics? The repayment term, the estimation of the cash flows from the respective financial instrument. The overall terms and conditions is required to be understood and well understood in order to properly audit the same financial instrument. Again, just taking a very simple example. I mean, let's say that the company has given a loan to a counterparty. Now, a loan has to be repaid after a certain specific period, and hence it's a financial asset. Simply put together, it can be recognized at amortized cost. But let's say if there is a very small term and condition in the contract that the counterparty has also got the right to convert the loan on meeting certain conditions or non-conditions, then the accounting will change, and then the auditing considerations will also change surrounding the same. And that's where I say that any financial instrument, understanding of the underlying term and conditions is imperative for we as auditors. Then the third consideration is, of course, as an auditors, I mean, we have to take help of experts for us to audit the financial instrument. We need to take help of accounting experts, as I explained, that the set of accounting conclusions can be complex on recognition, measurement, classification, etc. Hence, the auditor should take help of accounting expert. Then, for sure, the auditor should take help of valuation expert. I mean, any financial instrument, let's say an investment in an equity security, we discussed it will be fair valued through P&L. Now, if the equity share is listed, then determination of fair value can be reasonably easy. But if it is unlisted, then the valuation expert's role will come in very, very handy as to how the company is actually going about doing the fair valuation, what kind of model they have put in place, and all that. Hence, the role of a valuation expert becomes very important. Any derivative is required to be fair valued. Now, I mean, how the fair value is determined of that derivative. Hence, the auditor should take help of valuation experts to understand the underlying valuation of the respective financial instruments. And then, of course, IT experts. If there is a high volume of transaction, let's say these IT companies, they enter into forward contracts or derivative contracts in bulk. hence, what is the IT control surrounding the same? I mean, so that the transaction completeness is ensured and everything. Thereby the role of IT expert will also come in useful and handy. So as auditors, the use of experts is mandatory. I mean, while auditing financial instruments. Now, just giving you another example out of my experience only. I mean, we keep on talking about accounting complexity. And when the company issues equity securities, I mean, we all understand that those equity securities will be recorded as part of equity share capital. But understanding of terms and condition and accounting guidance is very important, because let's say if there is the entity has undertaken an obligation that these equity securities, I mean, the company can do a mandatory buyback after a period of 5 years or stuff, then these equity securities can actually get classified into liability. And not only that, I mean, that liability will be valued at fair value at the end of every reporting period. This accounting guidance is coming out of Ind AS 32. So that's where, I mean, the understanding of underlying terms and conditions and taking help of an accounting expert both becomes imperative where such financial instruments are there. Then valuation methodology, as I said, that when such instruments are there, let's say an investment in an unlisted company or stuff, thereby the fair valuation will not be readily available and the company will take help of a valuation expert. And in turn, the auditor should also take help of the valuation expert in order to vet the assumptions which has gone into the valuation of the asset. I mean, in Ind AS 113, it gives the entity a choice of a market approach or a cost approach or an income approach. So whether, first of all, depending on the financial asset, whether the entity has used the right valuation approach, and thereby and thereafter, I mean, in that valuation approach also, whether the company has used the right set of cash flows, the right set of discount rate, the right set of sensitivity, and all the right assumptions have gone. It's very basic for the auditors to audit, very important. And that's where the understanding of the valuation methodology and taking help of valuation experts will be important. Just touching upon these, I mean, a market approach or cost approach or income approach, all these are valuation approaches under Ind AS 113. Like a market approach is whereby an asset is valued based on what is the value of the asset which any other market participant is ascribing to it for a similar asset. So let's say we have got an investment in an unlisted entity. Now, similar investment, similar relatable or comparable investment in the market, any other market participant, what value he is ascribing to it, that is a market approach of doing valuation. A cost approach is as on today, I mean, building the same asset, what would have been the cost of doing it? That is a cost approach. An income approach means projecting all the income out of the asset and then doing a discounting of the same is an income approach, which is very commonly known as a discounted cash flow approach. All these approaches are there. Of course, I mean, depending on the asset, the right approach should be selected, and thereafter the help of and that's where the valuation experts come in handy. So, as I said, that first of all, determining the right valuation methodology, very, very important. That which valuation methodology, whether market approach or cost approach or income approach. Then once we have selected the methodology, I mean, let's say the company has selected an income approach to value a particular financial asset, then whether all the appropriate inputs have been given to the valuation model, all the right parameters have been given to the valuation model or not, whether the right discount rate has been taken or not. All the assumptions and everything which has gone into the valuation model should be looked upon by the auditor. And as auditor, it's very important to do a sensitivity analysis, which will give a sense of the materiality also, and that sensitivity is also a disclosure in the financial. which means that whatever assumptions or a discount rate we have taken, a 1% up or down, how much fair value is actually getting changed due to a 1% up or down is a sensitivity analysis. The more sensitive the asset, the more focused the auditor should be on the valuation assumptions and everything. So that's where these inputs to the valuation methodology becomes very important. Then another consideration which as an auditors we should be mindful of is offsetting of financial asset and financial liability. Many times it happens that we enter into a transaction with a single counterparty. A very common example I'll take. I mean, let's say that we take forward contracts or derivative contracts from a single counterparty. Let's say from a Standard Chartered Bank. Now, just because we have done this transaction with a single counterparty, that automatically does not mean that the company will offset the financial asset and the financial liability. Let's say that the company has taken 5 forward contract and 5 option contract for foreign currency from a single counterparty. Now, number of those derivatives will be in the money. Number of those derivatives can be out of the money. So it's not an automatic choice in the hand of the company to present the derivative asset or a liability on a net basis to offset the financial asset and a financial liability. The rule is very clearly articulated in the case of offsetting, that the company should have a legal enforceable right to set off, and the company should have an intention to set off on a net basis. So if the company has got a legally enforceable right to set off the derivative assets with the bank on a net basis, and the intention of doing it, then net accounting is permissible. Otherwise not. Otherwise, every derivative will have to be accounted on a gross basis. Okay, now moving on to the audit consideration. Now, consistency of method used across periods. I mean, as we have seen, another basic aspect of auditing is that as an auditor, we should look into the fact that whether the valuation methodology and recognition and measurement requirement, especially the valuation methodology, is consistent period after period or not. The fundamental rule or the thumb rule is that the valuation methodology should be consistent period after period, which means that we should really keep our eyes open that management cannot use an income approach in one period and a market approach in another period. It cannot happen. I mean, a fair valuation is always determined with respect to an exit price. So the management whereby they have assumed that the asset will be sold off in one market in one period and the asset will be sold off in another market in another period. So we should be very, very suspectable and we should apply professional skepticism to see that the valuation methodology is consistent period after period. As I said, that the valuation of financial asset is always very sensitive. A 1% movement here and there can really cause upside or a downside in the fair valuation gain or loss. And that's where the management can be lured into changing the methodology so as to optimize the result. And hence, as an auditor, it's our responsibility to design our audit procedures to check the consistency of the valuation model, the model's consistency period after period. And then the basic accounting assertions, the CBOP assertions, I mean, the completeness, existence, accuracy, the obligations and the presentation, those assertions should be applied in the case of financial instruments as well. So completeness, of course, the auditor should design their audit procedure to check that all the financial instruments have been accounted and all the disclosures surrounding the same have been included in the financial statement. Existence, I mean, obtain third-party confirmation, etc., in order to take comfort that the underlying financial instrument actually exists. Accuracy and valuation, as we discussed, that take the help of valuation experts in order to arrive at the valuation and the accuracy and in the recognition of the financial instrument. The obligation means the auditor taking the comfort that entity has disclosed all the event transactions and all the matters surrounding the financial instrument. And lastly, assertion is the presentation, which means that the entity has made all the disclosures related to financial instrument. So the auditor will be guided by the CBOP assertions in while doing and while completing the audit of financial instruments. So not only to financial instruments, but to every aspect of auditing, the concept of professional skepticism will be applicable. So applying this in financial instrument also, as an auditor, we need to make sure that sufficient appropriate audit evidence for all financial instruments have been obtained. All the applicable accounting and disclosure requirements have been taken care of. The management's judgment with regard to the financial asset or a financial liability, the management's estimation, valuation models, assumptions have all been vetted upon, and the auditor is comfortable with regard to the same. The internal control over financial reporting is rightly put in place, right from the date of acquisition of the financial instrument to the date of disposal. The entire life cycle is covered by internal control over financial reporting. Then sufficient IT system and information systems are there with the company to take care of the recognition and valuation requirements. And during the course of auditing and applying this professional skepticism, if any contradictory facts is coming to light, then highlighting the same to the senior management and thereby taking the right audit call. That all comes within the ambit of professional skepticism while auditing financial instruments. Now, we have seen the audit considerations, and of course, it was largely on a conceptual front that what all audit considerations will go while auditing a financial instrument. But taking just a couple of very simple examples, our intention, or at least my intention, to take these two examples was to demonstrate to the audience that that as an auditor, what all considerations should actually go in that particular transaction. If you miss any loop, then to that extent, you may miss the right recognition and the valuation methodology or the facts surrounding the financial instrument auditing. Now, taking a very simple example, let's say that there is a holding company which gave an interest-free loan to the subsidiary company of rupees 1 lakh for a period of 5 years. Now, interest-free loan. Now, the company has assumed a market interest rate of 10%. So, first of all, what should be the right accounting treatment? Now, on day one, the H company, which is the holding company, they will account for this loan at fair value. 1 lakh rupees interest-free, which means 1 lakh rupees cannot be assumed to be the fair value. Embedding an interest of 10% for a period of 5 years and then discounting the same is the fair value of the instrument. So the holding company will arrive at the fair value, which is 62,000 rupees. Loan account is debited with 62,000 rupees. The remaining residual of 37,000 rupees is a kind of a benefit which has been passed on by the holding company to the subsidiary company, and hence it becomes a kind of a deemed investment which will be debited. This deemed investment will be shown along with the investment in subsidiary only in financial statement. So, and then bank will be credited for 1 lakh rupees. The same subsidiary company will do. Subsidiary company will do a fair value accounting of loan from holding company of 62,000 rupees. And the benefit which subsidiary company received of 37,000 rupees will be a kind of a capital contribution which will be disclosed as part of equity, overall equity of subsidiary. It will be a separate component of equity when the company will disclose their statement of changes in equity. So that is the accounting which a subsidiary company will do. Now, this is a transaction. And if you see, as an auditor, it's not only determining the recognition and measurement requirement or everything, but the auditor should actually understand the entire cycle of this transaction in order to audit the same. So the entire cycle of the transaction is, first of all, why an interest, or the auditor should challenge the following fronts. That why an interest-free loan was given by the holding company to the subsidiary. Why an interest-free loan? For that matter, even the Companies Act Section 186 requirements are also there to do the transaction on an arm's length basis. So understanding the rationale of doing this interest-free loan transaction, what are the terms, conditions, and covenants related to the loan? Then how the what all accounting literature the company have considered while arriving at this accounting of loan to subsidiary and deemed investment. Then another aspect is valuation methodology, that how come the company arrived at this fair value of 62,000 rupees, all the estimates and judgments and this market interest rate of 10% also, everything should be audited, everything should be questioned. Then on what basis the deemed investment account has been debited, what is the underlying literature which has gone into it. Then another important aspect will be the taxability of this transaction, that whether the deemed investment or a capital contribution in the hands of the subsidiary, what are the tax implications, whether the company has consulted or taken help of any tax expert or not, and thereby determining the deferred tax implications of the same, and how deemed investment and capital contribution are getting disclosed in the financial statement. All these are audit consideration. It's not only this one journal entry, but this one journal entry in this case is giving rise to at least 10 questions which the auditor should cover in order to take comfort on the overall gamut of the transaction. Similarly, just taking another example, let's say a company J Limited, they issue 2,000 convertible bond at 1,000 per bond INR for a 3-year term. Interest payable annually at 6%. Issue cost is 1 lakh rupees. Each bond is convertible at holder's option at any time into 250 ordinary shares. At the time of issue, the market rate for similar debt without conversion option is 9% per annum. Now, this is the transaction. Now, first of all, the entity will do the accounting. Now, let's understand the accounting of this transaction. The entity has issued convertible bond, which will be converted at the end of 3 years. And the conversion option is given in the hands of the holder, which means if you see, the holder has got a conversion option. So from the point of view of the entity, there is a contractual obligation to pay cash also, right? The holder can come up and ask or demand for cash as well. So for the company, there is a contractual obligation to pay cash, which means there is a clear-cut liability instrument attached. And then there is an equity feature to this instrument as well, as the holder has also got an option to get the instrument converted into equity shares, and that to fixed number of equity share. So this is typically a compound financial instrument or a hybrid financial instrument, which means one financial instrument which has got a liability feature also and an equity feature also. To repeat or to reiterate, the liability feature in this instrument is entity's obligation to pay cash, contractual obligation to pay cash is what is the liability feature. And equity feature in this instrument is holder's option to get fixed number of equity share, whereby his risk and reward is also akin to equity. That's an equity feature. Now, in this instrument where there is a liability feature and there is an equity feature, first of all, the fair value of the liability component is determined, and then the residual portion is attributed to the equity portion. So how the fair value of the liability portion will be computed? The cash flow of the instrument will be determined. The cash flow of the instrument will be 2,000 convertible bond into 1,000 rupees per bond into 6% per annum, which is the interest. and then the principal portion which may have to be repaid at the end of the term. That entire portion is cash flow that will be discounted at market rate, and the discounted value will come to 17,55,716 rupees. That will become liability portion, and the residual will go into equity. So that is the accounting, and we can very well relate to this fact, or we can very well understand that once the accounting is complex, the auditing consideration to the same will also be complex. Again, as an auditor, we should understand that why the entity has done this transaction at a lower than arm's length or lower than market interest rate. What is the rationale of doing this transaction at 6% when the market interest rate is 9%? Then what are the detailed terms, conditions, and covenants related to the bond? How exactly the fair valuation of the bond is determined by the company? On what basis the company concluded that it's a compound financial instrument? What set of guidance and everything the company used in arriving at the same? How the company concluded the tax implication, whether equity will not be open or subject to one-time tax, or how the entity has concluded on the tax position of especially the equity component. And then whether all the disclosure requirements have been identified and disclosed by the company. All these considerations will have to be beared in mind and will have to be applied by the auditor to apply the life cycle of this transaction. So my intention was to just take a couple of examples of financial instruments or transaction to show that that the recognition, measurement, valuation of the transaction, that will be taken care of by the company, and it will raise a lot of questions on part of the auditors, which should be covered in a wholesome manner by the auditor. Now, some of the specific areas. One area which I specifically want to cover before we move on to some of the specific areas which I have mentioned on the slides is an area on hedge accounting. Of course, hedge accounting is a premium concept and a set of complex subject in Ind AS 109. And in hedge accounting, what happens is when the company takes a hedge instrument, let's say a forward contract, it's essentially a derivative, and the company can ideally do a fair value through P&L. But another accounting policy choice is hedge accounting, where instead of doing a fair value through P&L, the company can keep on posting the or keep on recognizing the fair value in other comprehensive income. And when the underlying hedged transaction takes place, that is the point of time when the gain or loss of the forward contract can be recycled from other comprehensive income to P&L. Just briefly covering that hedge accounting, the auditor should be very, very mindful as to how the company have first of all designated the entire hedge accounting, how the company have tested effectiveness. As to whether the hedge is effective or not, how the company have tested the same, how the company have determined the fair valuation of both the hedging instrument and the hedged item and everything. So if a company is following hedge accounting, it will be significantly enhanced level of procedures and everything which the auditor will have to follow in order to audit the hedge documentation. Now, covering some of the specific areas, these are some of the common issues which we see when we encounter financial instrument accounting or accounting related to some specific items of financial instrument. Now, borrowing. Now, in borrowing, want to just cover a couple of things. As part of COVID provisions also, the RBI gave a moratorium of principal and interest in the hands of all the companies on their borrowing. Now, it's a common set of questions which arose that whether the moratorium should be seen as a default of repayment of principal and interest by the company. And why this question was very pertinent was that if there is a default on part of the company, then specifically Schedule 3 requires the company to disclose the period of default as part of the notes to accounts. And that's where the clarificatory guidance also came. And that a moratorium of principal and interest should not be viewed as a default. It's a mutual agreement between the between both the parties, between the company who took the loan and the counterparty, and hence it should not be viewed as a default. And hence, accordingly, the moratorium of principal and interest should be disclosed as a modification to the underlying terms and conditions of the loan agreement. And hence, for moratorium of principal and interest, a modification of financial instrument accounting should be applicable and not the set of default of loan accounting. So modification of financial instrument accounting is whereby determining as to whether an existing loan is extinguished and a new loan the company has taken, or whether the existing loan of the company only continues. That is known as a modification accounting. That should be applicable to moratorium provisions. And of course, another issue which became, again, not really relevant these days, but another very common issue which came was, whereby the loan covenants, the company which were carrying borrowings in their balance sheet, the loan covenant got impacted because of COVID. And because the loan covenant got impacted, how the borrowing should be treated in the financial, whether it should be classified as a non-current or a current. And in this case, of course, we should look at the underlying guidance only, that if there is a minor breach in the covenant, then if there is a minor breach in the covenant and the loan has not become recallable as part of that minor breach, then the company can continue to classify the same as non-current. But where there is a major breach of the covenant, then the loan should be treated as current loan or current borrowing, unless the company has got a waiver from the banker or a waiver from the counterparty before the authorization of the financial statement that the loan will not be recallable. That's where the loan company can continue to classify the loan as non-current, else it will become current. Then, of course, some more impact of COVID, whereby the COVID provision should be the COVID impact on the company should be taken care of appropriately in ECL accounting, in expected credit loss accounting. So in ECL accounting, the auditor should see as to whether the probability of default has been increased by the company or not, and how the company has factored the same while making the COVID provision. In number of cases, what happened was that when the company was having borrowing limit, then the unused borrowing facilities was also used, and hence the exposure of default on part of the company also got increased. So whether that is getting covered as part of expected credit loss or not, and whether the overall provision metrics of COVID of ECL, the overall provision metrics of ECL is actually determined based on historical flow rate or historical cash flow rate. So whether a forward-looking assumption of a COVID default has been inbuilt into that ECL model or not. So that's what should be taken care of in ECL model if the company continues to be impacted by COVID. Now, these are some of the key accounting estimates and judgments. We have already discussed this, and the auditor should continue to consider the same. The impairment of investment of unlisted company in the light of COVID, the impairment of debtors, how the company has factored the COVID impact in their overall future cash flow estimation, what are the considerations of discount rate, if there is a contractual penalties in underlying financial asset contract, how the same has been considered. All these considerations while auditing financial instruments which are impacted by COVID should be dealt with as part of the audit. Now, a lot of us are aware that Financial Reporting Review Board audited or reviewed a set of financial statement, and of course, a lot of inconsistencies. not only in financial instruments, but wide range of Ind AS standards were identified, which was listed, issued by the FRRB. So, I mean, what I have done, just took a look at what were those some inconsistencies in financial instrument accounting also. As a group, we should generally be aware. I mean, although it can be much more, but at least some of the areas which were commented upon by the FRRB was, like in the case of FVTPL investments. Now, all the investments which are classified as FVTPL, the guidance note or Schedule 3 guidance note is very clear that the FVTPL investment or the fair value gains or losses on such investment should be disclosed as part of other non-operating income. It's very clear and very important also. It should be disclosed and categorized as part of other non-operating income. Other non-operating income is a separate caption within other income. There it should be classified. Whereas a number of instances FRRB came across whereby such gains or losses were being disclosed as part of other income only and not as part of other non-operating income. That was one area of observation or one area of inconsistency to the guidance which FRRB observed. Second area, and I was surprised when I came forward or when I came across to this observation, that number of companies are having forward contracts, and the companies were under the old Indian GAAP regime. The company was following AS 11 accounting to that forward contract, and the companies continued to follow the same in the Ind AS regime as well. I mean, just carried forward the AS 11 accounting even in the Ind AS regime, which was kind of completely inconsistent to the guidance. The guidance on derivative or Ind AS 109 is very clear that all the derivatives should be fair valued through P&L or hedge accounting should be followed. So that is the guidance which should be which the company should be following, and not the erstwhile AS 11 guidance on forward contracts. Then a reclassification of forex gain on losses on disposal of foreign operations. Now, if there is a net investment in a foreign operation, or if any foreign operation, I mean, let's say an investment in a subsidiary or investment in a branch or any foreign operation have been designated as a net investment in a foreign operation, that's an accounting concept and it's an accounting choice available in Ind AS 109. The guidance is again very clear that once a designation of a net investment in a foreign operation is done, then all the monetary assets and monetary liability, whatever exchange rate differences are arising on the same, it should all be clubbed into other comprehensive income, and they should only be recycled from other comprehensive income to P&L when the foreign operation is actually disposed of. It's very clear, there is no ambiguity. But a number of instances, again, the FRRB observed was, and it's a very common mistake actually. Number of instances, the FRRB saw that when the underlying monetary asset or a liability is actually getting settled, then the related exchange rate gain or loss is also getting recycled from OCI to P&L. That is wrong. When a designation has been done of a net investment in a foreign operation, then all the gains and losses which has been parked in other comprehensive income will actually come to P&L only when the foreign operation has been disposed of, and not when the underlying monetary asset or liability is getting settled. It's a good observation. It's a common mistake which we also encounter. Then incorrect presentation of foreign exchange loss, again very common. I mean, the guidance note is very clear that exchange rate loss should be presented as part of other expense, but a number of instances whereby FRRB observed that the exchange rate loss is actually getting disclosed as a reduction of revenue and not as an other expense. So these are some of the common errors or observations which have been noted by FRRB. I mean, as auditors, as accountants, our responsibility to be aware of the same and take care of the same while doing the financial instruments accounting. That's all I had. I hope, I was able to put through the message and some of the auditing and accounting concepts of financial instrument, which I intended to do. And now I pass it on back to Anilji.
Thank you so much, sir, for a wonderful deliberation. Sir, can you hear me?
Yes. Yes, sir.
Sir, thank you so much for detailed deliberation. I have received certain questions. If you allow, can I raise those
Yes.
questions, sir?
Sure.
Sir, first question is, how can one audit the records in regular course vis-a-vis keeping in mind forensic audit?
Yeah. Can you repeat that, Anilji?
Sir, question is, how can one audit the records in regular course? That means auditor is auditing in regular due course, but while keeping in mind the forensic audit. Means what precautions and what guidelines he should follow while the regular course of audit, keeping in mind the forensic audit.
Yeah. So not really related to financial instrument, but forensic audit we should be very mindful of. Wherever we see a risk of fraud, wherever we see a potential fraud risk threat, that is the right time for the forensic auditors to get involved. And as a statutory auditors, I mean, that is the time when we should take help of forensic auditors who can further go deep inside that potential threat of a fraud risk and give us the comfort as to whether that risk actually exists or not. And if it actually exists, then there is a different set of procedures which the normal auditor, statutory auditor will comply in terms of discussing the same with the senior management and then taking it forward. So to start with, it's the potential existence of a fraud risk which will really entail the involvement of a forensic auditor as well.
Yes. Sir, whether margin money or security deposits will come under the financial instruments, financial asset or liability?
Yes. So security deposit, I mean, assuming that a security deposit is given, which will be refunded back to the company after a point of time. I mean, let's say a rental deposit, it's refunded back to the contractual provisions are that it will be refunded back to the company once the underlying property is vacated. All those security deposits which will be refunded back to the company after a period of time in cash, all those are financial assets. And similarly, margin money, they are generally adjusted against the delivery at the end of the period. So depending on whether, again, whether the contractual provisions require a refund back to the company after a certain period, then it will become financial asset, otherwise not.
Yes, sir. So you have mentioned if any entity issue equity shares with a buyback, you mentioned it is a liability. But sir, Companies Act does not permit buyback of shares as per in my understanding.
No, Companies Act, they permit buyback of shares subject to fulfillment of some conditions which are mentioned in the conditions. So, I mean, a certain portion of the reserves and equity share capital will have to be ascertained, and a percentage of the same should be utilized towards buyback and so on. So there is a set of guidelines both in Companies Act and in SEBI guidelines as well for buyback, which has to be adhered to, and subject to fulfillment of the same, buyback is permissible.
Yes, but subject to certain conditions.
Yes.
Yes. Sir, you have also mentioned and quoted one example of Standard Chartered Bank. Yeah. And being one country, and being one counterpart, why should offset not to be allowed? You have mentioned it cannot be. So kindly put some light on that. Why it should not be offset to be allowed?
Yeah, absolutely. So just to clarify, I did not say that offset is not allowed.
Yes, sir.
I'm saying that the provision of offsetting is that if a company has taken 5 forward contracts and 5 call options for a foreign currency to buy foreign currency from Standard Chartered Bank, the company by default should not take an accounting policy choice of offsetting. That the gain and loss of all the 5 forward contracts and 5 option contract will be determined and they will be offsetted with each other. That's not a default accounting policy. The accounting policy of offset can only be taken if the offset is contractually permissible and if the entity has got an intention to settle it on a net basis. If these two conditions are getting fulfilled, then the company can do offset accounting. Otherwise, the company cannot do offset accounting.
Yes, sir. Yes, sir. Sir, in case of a proprietary concern, how do we value equity shares or mutual fund held as an investment?
So mutual fund, it depends on whether what are the conditions attached to the mutual fund, whether it's an open mutual fund or a closed mutual fund, whether the readily available NAV is available to the mutual fund or not. I mean, if a readily available NAV is available, then a readily available fair value is available. But if that is not available, then the company will have to resort to a valuation technique. And in the case of a mutual fund, it can be either a market approach or an income approach, which the company should follow. For sure, in these instances, the company will have to take the help of a valuation expert who can determine the appropriate method also, and then build on the right set of assumptions and valuation technique while applying the same.
Yes, yes. So one more question. This is relating to the SPV account. One member is asking, in case of multilateral funding agencies like JICA, AFD, etc., for metro rail projects in India, which are SPVs, the loan instrument comes with a tenure of 20 to 25 years and with a moratorium of 10 years. What should be the treatment in books of accounts of SPV?
So the SPV has taken the loan, right?
G.
So although a very specific case, and
yes.
Generally, as part of this platform, we tend to avoid covering any specific case, as it can tantamount to an opinion, but generally covering the provisions and guiding the respected member. If a moratorium provision is there, the company has taken the loan, and the company will record it at amortized cost. And the company will then recognize the same based on EIR method, effective interest rate method. Now, for the company to apply an effective interest rate method, the company will estimate the overall maturity period of the loan. If the company expects to take the moratorium, which is available under the contract, then the company should build that moratorium period as part of its EIR model. And if the company does not expect the same, then the company should not take it as part of its EIR model. That's where the moratorium should be factored while doing the loan accounting by the company.
Yes, yes, yes. Sir, for the purpose of discounting the investments in non-convertible debentures, can a company use the IRR of the respective instrument instead of market rate applicable to the similar instrument?
Yeah, very common question. Generally the answer is no. It's very it's quite clearly articulated that it's market rate of interest, and that to an incremental kind of an incremental borrowing rate, which means that the similar instrument, what is the rate at which it is available in the market. So an IRR is a rate which is very, very specific to the company and to the company's instrument, which is not permissible. It is a market interest rate.
Yes, sir. Sir, can you, member is requesting for one or two examples of fraud risk in the financial instruments?
So, just giving a couple of simple examples which we generally come across. A clear indication of fraud risk is where the management is trying to change the valuation methodology or valuation assumptions period after period. That's a clear indication of fraud risk. Another clear indication of fraud risk is not having enough controls in place. How the company does not have an adequate system to determine the extinguishment of a particular financial instrument, a financial asset, or a financial liability in itself gives rise to a fraud risk. Then the management, if you see, a financial asset accounting is very much also governed by management's intention as to whether the management is business model is to hold the asset till maturity or a dual, and the management changing their business model period after period is another very big indication of fraud risk. which may suggest that the company is trying to achieve some financial statement optimization or objective. These are, again, I would say, these are indications of fraud risk. It doesn't mean that there is a fraud which is happening. This will make the auditor susceptible to a fraud, and he can take help of a forensic expert to get the comfort as to its existence or not. I mean,
Yes.
like another example in the case of revenue recognition, which we very commonly see, as to the pattern of revenue recognition, whether more revenue is booked in the later stages, and if that is the case, definitely it's an indication of a fraud risk. The same things will be applicable to financial instruments, as to whether the management is trying to play around valuation and accounting and stuff to get some kind of optimization. That is what is a potential threat to fraud.
Yes, yes. Sir, how do we account preference share convertible only upon some conditions? Example, IPO of the company occurs with predefined period or conditions like pricing of the public offering, etc. So how do we account the preference shares?
Yeah, again, very specific. But I'll address this. A preference shares convertible upon fulfillment of some conditions. Generally, in this case, we see as to whether the fulfillment of those conditions is within the control of the company or not. I mean, if just think like this, if the fulfillment of the condition is outside the control of the company, then basically the company is contractually obligated to pay cash. And IPO is one such event where the guidance says that it's a condition which is outside the control of the company. It's not in control of the company. And hence, if it is linked to a successful IPO, then it's an event which is outside the control of the company, which means there is a contractual obligation to pay cash. And generally, generally it should become a financial liability. Of course, it will depend on other terms and condition also. As to whether there is any embedded derivative in the contract or not, but generally it will tilt towards a financial liability classification.
Yes, sir. Sir, expected credit loss like the provision for doubtful debts. So, if we talk about the ECL model, so what are the what guidelines you should suggest for this ECL model?
For ECL model, I mean, the models are available. If you have a debtor and taking a simple industry, I mean, let's say a consumer care industry or an FMCG industry. I mean, if you have a debtor which are not, whereby the credit period is not large enough or big enough, there we use a simplified approach of ECL. I mean, and there we use a general approach of ECL, and ECL has got two approaches: a general approach and a simplified approach. So there we use a general approach whereby a expected credit loss of the next 12 months is determined. And generally, there is a mathematical or a statistical model to it, which computes the past payment trend of the customers, which is known as the flow rate. Based on that, an expected credit loss is arrived and a provision matrix or a flow matrix is determined. And that provision matrix is applied to the underlying debtor in order to arrive at a provision. So this is quite a settled practice now, given the fact that these provisions came in 2015. So, I mean, you can connect separately, and we can help you with that model. And these are very much now available with the institute and in Google also. If you see, I mean, these are known as these are all statistical models of computing ECL.
Yes, sir. So now we come to an end, sir. Thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India for sparing your valuable time and enlighten all of us on various intricacies of audit consideration while auditing this financial instruments. In spite of having your busy schedule in this very busy month, you have acceded to our request for this deliberation. So once again, on behalf of AASB, I extend my heartiest thanks towards you, sir. Thank you so much, sir.
Thanks a lot, Arilji. My pleasure.
Thank you, sir. Thank you, sir. Thank you. Good day.